You might have heard about the new capital gains tax rules that kicked in this year in June and are wondering how this impacts your finances. Are you going to have to pay 67% on your investment profits in Canada now? Has it become that bad? Or are these new tax rules only a worry for the ultra-rich, the top 0.13%? Both are misconceptions and far from the truth. So in this video, let's break things down. How do these tax rules really affect your finances? Not only the direct financial impact, but there's also the indirect impact on your finances, quality of life, and future of Canada, something that's not talked enough about in the media. Let's first talk about how the capital gains tax works. I note that I'm not a financial advisor or a tax expert, I'm just sharing what anyone can read on the internet. Capital gains tax is a tax that you pay on your capital gains, and what's meant here is realized capital gains. Here's an example. Let's say you bought $100,000 worth of NVIDIA stocks a few years ago and now it's worth $600,000. If you sell them all today, you'll realize a capital gain of $500,000. And your capital gains are taxed at the same tax rate as your income, but not the entirety of it. Only a portion of your capital gains are taxed based on what's called the capital gains inclusion rate. And this is the main thing that has changed in the taxation rule, the capital gains inclusion rate, which dictates how much of your capital gains is taxed. A 50% inclusion rate is applied to capital gains of up to $250,000 and a 66.67% inclusion rate on capital gains above $250,000. In our example, your taxable capital gains amount to $291,675. This amount is then added to whatever your personal income is, your employment income. For simplicity here, let's just say your total income is $291,675. This amount will be taxed based on your income tax bracket. So these would be your federal taxes, and these are provincial taxes if you live in Ontario. To make it easy, I use the Wealthsimple tax calculator to estimate the taxes, excluding CPP and EI here because we're just looking at the income taxes. So you would pay about $112,050 in taxes on your capital gain of $500,000. That comes down to an average tax rate of 22.4%. Do you think that's a lot or not? Now let's compare this to the old rules. Previously, the inclusion rate was just 50%. In our example, the taxable capital gain would be 50% of $500,000 equals $250,000. The taxes on that would be approximately $89,742. In other words, in this scenario now, you'd be paying $22,000 more in capital gain taxes compared to before. And yes, there is what's called a lifetime capital gain exemption, or LCGE, of about $1 million, but it only applies to certain cases, like when you own and then sell a qualified farm and fishing property or qualified small business corporation shares. So to recap, the capital gains tax didn't increase to 66.67% or 2/3, which would be just ridiculous, but the capital gains inclusion rate increased to 66.67% for gains above $250,000 from previously 50%. And that's if you sold all of your shares at once, so that your capital gains exceed $250,000 in 1 year. Now I know that some of you might say, this doesn't affect me. I don't even have $100,000 or $50,000 in investments, let alone gains. And true, it doesn't affect me either, at least not right now. But we'll talk later about how this still affects you indirectly. And also, who's to say that it won't impact you at some point in your life later? I mean, if you're seriously on a wealth building journey, you could hit that point sometime in the future. This person in the example earning a few $100,000 from their investments is not a sample of just the ultra rich who earns millions per year in income, but could be someone in the middle to middle upper class, earning between $100,000 and $200,000 per year. You could be investing in a growing stock like NVIDIA or an index ETF or Bitcoin, and after 10 years be really bummed by that higher tax rate, unless there's a new government that softens the rules. Here's the thing, what's often not mentioned is that even though this rule doesn't affect as many people right now, it will affect more people over the course of their lifetime. Now, one way to mitigate just parts of these effects is to invest as much money as you can in tax advantage accounts like the TFSA, where your capital gains are sheltered from tax. And you can easily open a TFSA on any investment platform out there. The one I like to use is Wealthsimple because there are no trade commissions and it's super easy to use. Use my referral link in the descriptions below, and once your account is funded, both you and I will each get $25 as a bonus. But now let's talk about another way that many people in Canada, especially in their 40s to 60s, will be affected. And these are a lot of regular people. A lot of people in Canada are renting, of course, well into their 30s and 40s because property prices are just too high. Let's say a person, Joe, let's call him, is renting in Toronto, but at some point his parents pass away and leave him a house, let's say in Thunder Bay. Now here's what's interesting. In Canada, there are no inheritance taxes, but that doesn't mean that there's no tax though. Yes, the great thing is that when you sell your property that's your primary residence and where you live, the capital gains are not taxable. But that would mean that Joe would have to move into that house in Thunder Bay. So if Joe now inherits this house in Thunder Bay, but he doesn't want to move to Thunder Bay, can we blame him, and prefers to rent it out instead, then this house would be his secondary residence, and he will have to pay capital gains taxes on it. Now imagine if his parents bought the house for $60,000 in the 80s and now it's worth $560,000. He would have a capital appreciation or gain of $500,000 and would have to pay more than $100,000 in taxes on that. Now I know that before the new rule he would also need to pay taxes in this scenario, but at least it was less. Here's another scenario where this could affect you in the future. If one day you invest in a second or even third property outside of your primary residence for additional income. This is also not a 0.13% population problem, but something that many people in regular jobs do. After securing the first home that they live in, they invest in a second condo, for example, to earn some rental income. And at some point, they might want to sell it. And the new tax rules will take a harder hit on them as well. These extra costs have to be factored in by anyone who wants to earn money, landlording to earn extra income, or simply invest in properties for the capital appreciation. Now, what about corporations? For corporations, the inclusion rate has been increased to 66.67%, but starting from the first dollar, from previously just 50%. And I know that when we hear the word corporation, we tend to think of these big companies like Rogers or Air Canada, but a corporation could be as small as just one person. For example, in Canada, 50% of physicians, doctors, are incorporated. Doctors who made a profit through their corporation invest the surplus, for example, in the stock market, and many plan to use these capital gains to finance their retirement. Because unlike employed doctors, these incorporated doctors don't get any benefits, so they rely on their investments for their financial security. But now, with a higher inclusion rate of 66.67%, they pay much higher taxes than before. And there are many more details to this, and anyone watching this who is a doctor or an incorporated professional, please feel free to contribute in the comments. But I can't imagine it to be quite disincentivizing. And remember that Canada already has a shortage of doctors and difficulty retaining them. Canada is short nearly 20,000 family doctors until the year 2031. So you can see how this change could affect you directly. Difficulty finding doctors and longer waiting lines. And even though you don't own a corporation yourself, but these tax hikes could be a disincentive for any talented professional thinking about moving to Canada or staying here, professionals whose service you might need. It wouldn't be surprising if they look elsewhere where they're treated better. And in fact, many of them are doing this. And this is where we cross over to the indirect effects and hidden costs of this capital gain tax change that are not often talked about. We don't know for sure what the effects are in the long term, but an increased brain drain from Canada could likely happen. Fewer doctors is just one of many possible problems. If you're looking for proof, brain drain is already happening. In 2022, 126,000 people left Canada for the US, among which not all, of course, but many are skilled and talented people. Also, brain drain isn't something that happens immediately, but over the long term, and only time will tell how large the impact will actually be. Other businesses could also lose interest investing in Canada. For example, tech entrepreneurs, innovative companies in general, startup founders, investors, and real estate developers. One mistake that people often make when assessing a government policy, such as this capital gains tax change and also the carbon tax, is that they only look at the direct effects. For example, this won't affect me because I'll never earn more than $250,000 in capital gains. And forget that for every economic policy, there are a series of trickle effects. Canada, like any country, is not a standalone country. We live in a global economy and are always in competition with other countries for talent. And the capital gains tax increases definitely doesn't make it more attractive for great people to come and invest or even stay in Canada. And don't forget that Canada already has an economic problem to begin with, and I talked about this in my video about Canada's productivity problem. A nation's productivity strongly affects their people's prosperity. A nation with higher productivity has more economic growth and job opportunities. But Canada's productivity is on the decline, among others, because of lack of investment into businesses and also lack of innovation. Another thing to consider, some people say, yes, the capital gains tax inclusion rate increased, but only by a bit. Yes and no. Even if you think that the change is small, wouldn't you want the tax to be slightly less than slightly more? It depends on where you stand on taxes in general, I guess. And what precedent does this set for future government direction and policy? Is it really a good strategy for the government to increase their income from taxation rather than focusing on other sources of income? Now, bringing it back to an individual level, here's also a misconception that's important to think about. It's often argued that low capital gains tax only benefit the ultra-rich, but we could argue otherwise. People who are on the threshold of what we typically refer to as middle class to upper middle class and beyond are negatively impacted by this tax. You've all heard of the problem of stagnant wages in Canada, and even if you don't believe it, you'll at least agree that wages are not skyrocketing. You're lucky if you get a 5% raise each year, which you'll have to work with to combat the real inflation rate, which is actually much higher than the publicized CPI of 1 or 2% or whatever. So the only other tool for someone to climb up from the middle class, if not through their wages, is through capital gains. Now, what happens with a higher tax? It dampens your financial growth, and it could also make potential business investors think twice about taking the risk of starting a business in Canada that could create more jobs for Canadians. Now, let me know what you think about this. Are the new capital gains taxes too high or too low? Or should capital gains not be taxed at all, considering that the initial income that went into the investment had already been taxed? Let me know in the comments down below. I'd really love to hear your thoughts. If you want to learn more about how to use the TFSA to grow your wealth faster, watch this video next.